loans.
So it's private credit. It's basically syndicators who raise money to lend money instead of raise money to buy buildings.
They're probably looking at, $1.5 billion a year of revenue minimum. In private credit, you can estimate the revenue of the company, maybe a 1 to 2 or 2.5%, depending on the details, and multiply that by the size of the loan portfolio. So $1 billion fund, that'd be a $20 million revenue for a $1 billion fund. The era of zero interest rates, or effectively zero, is gone. Historically normal interest rates, call it 4% versus zero, that is an enormously painful adjustment.
All right, guys, before we get into today's video, I want to give a huge shout out to Loan Titan, the exclusive lending partner of this channel. Loan Titan has been the #1 lender in the Los Angeles area for years, consistently trusted by both brokers and borrowers. They offer mortgage solutions tailored to just about any situation, whether it's Fannie, Freddie loans, non-QM programs, construction loans, multifamily financing, or even land loans. They also offer in-house private money financing solutions for fast closings, distressed sales, or if you just need access to your equity quickly. And here's a bonus. If you work with Loan Titan and you mention that Taylor Avakian referred you, you'll get $500 credited towards your closing costs. Their team is highly responsive, transparent, and genuinely easy to work with. Head over to loantitan.com and make sure you tell them Taylor sent you. Huge thanks to Cal Tizani at Loan Titan for supporting today's video and supporting the channel. Now let's jump back into it. Welcome to the podcast. My name is Taylor Avakian, and I am here with my esteemed guest, Jan Brzeski. Jan, thank you for being here.
Taylor, thank you for having me. Great to see you.
Of course. So walk us through, you were one of the co-founders of Arixa, which is a massive debt fund. What drove you to start the lending business, 15, 20 years ago?
The Arixa business, wow, how can I condense that into a short amount of time? I was working for a family-owned real estate investment and syndication company, and I kind of hit the ceiling there, and I needed to start my own business. I kept working with my former employer mentor, who's Sam Freshman.
Oh,
for a
no
while.
way.
Yeah, I worked for Sam and learned a lot from him. I learned the lending side from him because during the financial crisis, the first phase of the financial crisis, he was using his liquidity to do some lending to opportunistic investors on kind of commercial real estate stuff. And then I had the opportunity to meet Trixie Weiss, who was the founder of Arixa Capital, not too far from where we are right now. And I really liked the loans she was doing. She was lending money to people that were buying houses in foreclosure or, at the courthouse steps. And I wanted to start a fund. And I realized this would be an easy way to start a fund because the check sizes were really small, and also the investments turned over rapidly, so I could build a track record.
Got it.
So it was really kind of a combination of things. I didn't set out to be a real estate debt guy, but I'm glad that I discovered this niche back in 08, 09, because this is what I'm best at.
Mm-hmm. And explain to people who don't understand, like, what was Arixa, or what is Arixa, and what is that market exactly?
Well, Arixa started out as my vehicle to just have my own business separate from Sam. And it originally had a different name, which was sort of aligned with Sam's company name. And then I had to change it because of a trademark infringement issue. And so I came up with this name Arixa, which is actually based on, it's a small town in Namibia in Africa, because my wife was doing work there.
Wow.
She was there for a trip, and I was looking at the map, and I needed a new name. But what Arixa is today is a lender. I don't want to speak for them because I'm not part of leadership anymore. I sold most of my interest about 2 years ago, and I'm cheering on from the sidelines as a small, passive minority investor now. But they've now done $6 billion of loans. They've done a lot of single family loans to builders and spec developers. They've done a lot of multifamily, townhomes, apartments, a lot of construction loans.
So it's private credit. It's basically syndicators who raise money to lend money instead of raise money to buy buildings.
Yeah, I mean, syndicator it's a fund management model. So there are lenders who do a loan and they bring together a few investors for that loan, and then they do another loan. But that model, I think, has some limitations to it. So what I started doing in 2010 was we started a fund, and that was my central goal, was to have a fund where we could recycle capital and always be open for business and not have to hope that we could find some investors for this loan or that loan, but rather we said we're going to be a lender and we're always going to have the ability to take in capital, and we're always going to be open to lend money as well.
How did you convince people to give you that first money for the fund?
Well, the first investor in the fund was me, of course, and I did what I could, which was small. I actually invested in 3 individual loans before launching the fund, and I also brought 3 people into those loans, 1 into each loan, to sort of sanity check. Does this make sense? This really seems to make sense to me, but do you want to go 50-50 on this loan, and then this loan, and then this loan? And then those investors became my first 3 investors, or 2 of them did actually in the fund. And then it was just a function of people I had met one way or another, and I would say to them, this is what I'm doing. I think it makes sense. We're not going to hit home runs, but I think we're pretty well protected on the downside. And the initial investors tended to be people I knew through working with Sam through the industry, or people that I had worked with in my past jobs. Like my first job was at Goldman Sachs, so I called some of the people from those days and let them know what I was doing, and a couple of them said, yeah, if you're doing a little bit of this, I'll do some too.
Mm-hmm.
And then I had some neighbors in there, I kind of wouldn't be pitching that I'm raising money for the fund, but if somebody appeared to be interested, I would tell them, you're catching up with your friends or people you just say, this is what I'm working on. This is my job. And if they express interest, I'd say, well, if you want to learn more about the fund, we'll send you some information about the fund. But I wouldn't push it because there's no reason to. And, it's sort of, things happened organically over time. It was very slow though. I will tell you, the capital raising was very, very slow at the beginning because the amount of money I could raise per investor was about $100,000 or maybe 200.
Oh, wow.
And so,
it's not a lot when you're lending out money.
No, it's very much of a snowball kind of business, which is like, you better not be counting on a lot of income in your first 2 or 3 years.
So walk me through the economics of, like, what was your pitch to investors? What was their return? How did you structure it? Were you getting a preferred return? Like, walk me through the economics of a fund, a private debt fund.
Okay, again, you're asking wide-ranging questions, and we ultimately did quite a few different vehicles there, and they now have grown even further under Greg's leadership, my former partner, and Seth. But the first fund did have a preferred return of 8%, but we then got rid of that for reasons that I could go into. We decided not to have a preferred return, and the economics for us are pretty simple. We would collect origination fees from the borrower, and that was the majority of our income. There were some cases where some of that origination fee might go to the investors in the fund as well. But most of the time we charged, call it a 1.5% origination fee or something like that. And then that was most of our revenue. And the rest of our revenue was an asset management fee that we charged to the investors, which typically was about a 1% fee.
Got it.
So real simple economics is, you're making maybe 60% of your revenue from the borrowers and 40% of your revenue from the investors in the fund.
Got it. And what were the terms of the loans when you first started? Like, what were the rates you were lending out? What was the timeline on those loans?
Yeah. So 2010, when I first started the first fund, we were buying loans from Genesis for the first 6 months or so.
Okay.
And so I think I was getting, at that time, I think it was like a 11.99 or 12.99 was the rate that they would usually have. And then we got a point. I believe that Genesis kept a point, and we got a point.
Got it.
And then I started originating loans directly because at one point Genesis was not able to sell us the loans when we needed them. So that's when I met Greg. Actually, he was a borrower. He became a borrower first, and then he became my partner, and now he's running the business.
Got it.
And what was the other question, Taylor, that you asked about
the economics of the
loans,
the rates? Yeah, the
rates. Yeah,
exactly.
So that changed, and those rates came down and down and down and down to the point where we were lending in the 8s at one point, to be competitive.
Yeah.
And by the way, there's companies like Lone Oak that have been doing this extremely well for a long time. and they would lend even a little lower rate than we would because their leverage point was a little lower and they didn't do any construction loans. So our philosophy was always, um, let's charge a little more than Lone Oak, but let's make sure the borrower is getting real value for that. And we could do some things that Lone Oak wouldn't do, but still safe.
Got it.
In our view. And so the rates came down to the kind of the eights, low eights even at one point. Then they came back up into the tens, and I think now they're coming back down into the nines.
Got it.
And in some cases, there's back into the eights even though interest rates are a lot higher now.
What is LTV typically on your first position loans?
Yes, we do senior loans.
Okay, and what
And by the way, I've been talking about what Arixa does.
Yes.
I can't speak for them, but this is to the best of my knowledge. But I have my own business now too, which we haven't talked about, a small new lending business that's doing somewhat similar loans and smaller though. And, so I should probably speak to what am I doing and how am I charging for it
Sure.
today, because I don't want anybody to think
Yeah. This is
I'm speaking for
history.
Arixa.
Yeah, of course. So are you lending up to 80% loan to cost? Like, how are you protecting your borrowers? Your investors.
Right.
Say.
So my sweet spot is always around 75 loan to cost.
Okay.
If I really like the borrower and I really believe in the business plan they're doing and their projects, and they have, they've either got a track record or they've got a niche that's a very special niche where I'm confident they're going to make money. I feel like 75 loan to cost is okay if they're going to make enough margin that we end up being around 65 loan to value when it's finished.
Got it.
There are some cases in our industry where leverage points have gotten higher. For example, single family fix and flip loans in middle America or North Carolina, where I started this business, actually, my new business. There are people advertising 90% leverage there. And I don't like that. I don't think that's a smart way for the industry to go, but we could go into why. But for certain types of loans, there is higher leverage available now.
Got it.
But for me, 75 is kind of a sweet spot. We have pushed up to 80 for some borrowers in order to win business if we need to, especially in North Carolina where it's more common for people to be used to getting high leverage.
Sure. And what makes a good lender? Like, are you really good at underwriting risk? Are you really good at generating business? Like, how do you differentiate yourself besides just the cost of what you're lending?
Well, so what makes a lender really good is the question, right? Certainly you have to have deal flow, right? You have to be getting good loan requests from good borrowers.
Yeah.
So I think the number one thing that makes a lender a good lender would be forging relationships with borrowers that you want to be lending to and having a way to systematically take care of those borrowers, do a great job for them so they keep coming back to you, and then they refer you to other people. And then the other side of that, which is, equally important as a lender, is you have to perform and do what you said you were going to do every single time, basically. You have to find a way to not overcommit. And a lot of people, it's easy to say, but actually there's a lot of people that do overcommit. And then they end up harming their relationship in the market because they couldn't perform, or they retrade at the last minute, or some investment committee in New York says, oh, actually, we're not comfortable with this loan, so we're going to cut the proceeds, stuff like that. I don't think you didn't ask what makes a good investment manager, but that's the other half of what we do, right? And so that's where avoiding bad loans comes in, and having a good track record and stuff like that. But this is one of the things I love about the business is there's two completely separate parts of the business. There's the one type of client, which is borrowing money, and you have to be great at lending for them. And then there's another kind of investor who is just trying to place money passively and earn income, and you have to do a great job for them also. And that combination is what keeps it interesting to me, and why I can't leave this industry. I'm going to do this for the rest of my career. I just like it so much.
Yeah. This is what feeds you, and you're good at it, clearly. I mean, you were able to build Arixa when you were there to $1.5 billion, I think, assets under management.
Well, I think we had more than $1 billion loan portfolio when I stepped back, and they're substantially beyond
I
that
think
now.
there's 6 billion or something like that.
Well, they've originated. They just announced $6 billion of loans
Jeez,
since inception.
that's crazy. So let's I want to talk about the new venture a little bit. So essentially, you're trying to rebuild a new company, but Arixa, it's a debt fund, right? How is this version different, or how is it improved?
Well, I don't want to compete directly with Arixa for a lot of different reasons. They are a great company. I'm friends with everyone on the senior team there. I'm still an owner of the business, and that's an important economically to me that I protect that investment that I have in the business.
Sure.
But at the same time, when I was in North Carolina, a little over a year ago, trying to figure out what's the next phase of my career going to be all about, I did come back to this niche because I wanted to be able to work on a business where I knew how to do it, and I knew that I wasn't going to be kind of making it up as I go and learning tough lessons along the way, right? Because one of the things about starting a business is that you learn tough lessons along the way, right? I've found that. And decisions have consequences, and when you make decisions that don't work out, I didn't want to have that happen. I didn't want setbacks that were like, oh, geez, that's a huge setback. I just wanted to feel like I was steadily being able to make progress. So I did come back to doing similar kinds of loans, but in North Carolina, because I was living in North Carolina at the time. And that worked pretty well. We found some borrowers there that needed the kind of service that we offered and the loans we offered. And so I got the fund going there. And then I lived there for about a year and a half. And then 6 months ago, and that was for family reasons, 6 months ago, my wife and I moved back to LA, to our house here in LA. And so we've been pretty active in Southern California as well. And when I say active, I mean small scale compared to Arixa. I think we're comparable to Arixa in its early days now.
Okay. What is the size of the fund at the moment?
So the fund is probably in the neighborhood of $12 million or so of capital invested. We do have loans that we've sold, so we allow investors to participate in individual loans.
Okay.
And we might have another similar amount that we've sold, maybe another 12.
What does that mean when you say you sold the loans?
Well, so I originate a loan, let's say it's a $1 million loan, and I can turn around to investors that like to invest in loans and say, would you like to buy 75% of that loan? And then we can sell them a loan participation, and they get their share of the income from that loan.
Got it.
And
so you free up some capital.
It allows us to recycle the capital that's in the fund. It also has a little bit to do with my agreement that I made with Arixa to limit my assets under management to a certain amount. So I have the ability to do more loans if I sell some of the loan production that I do. So that's a little different than when I did Arixa. We were really doing, at the first several years, we only lent what we could hold on balance sheet through maturity, and we didn't sell loans because there wasn't really a market for that at the time either. And this time around, I am selling actively, maybe half or a little more than half of our origination.
So then the way that you're making money is you're originating the loans, so you're getting a 1.5 or whatever on the origination. So $1 million, you're getting, what is that?
$15,000.
$15,000 right up front.
Yep.
So then you have $1 million loan, and then you're going and selling 75% of that to someone at $750,000, or is there a discount to it?
No, it's at par. They do not typically participate in the origination fee.
Okay.
Since we've already funded that loan and it's on our books, and we do charge a servicing oversight fee to them of 50 basis points.
Okay.
So that's how our model works.
And then because you have asset management fees as well for the fund, right?
But yes, when we sell a loan, we're not charging an asset management fee to the loan buyer.
Okay.
Because we're not managing those assets. They are managing their own assets. They directly own a portion of that loan.
So you take less, so you're getting less asset management fees when you sell loans versus keeping them on the books.
Yeah, we get a different type of fee. It's, I call it a servicing oversight fee. But it's a smaller percentage, and it's really designed. Loan sales are designed for larger investors that want to pick and choose which loans to participate in.
Got it.
And I think that investing in a fund is for people that don't want to be as actively involved in the decisions of which loans to do or whether to extend a loan, or, you know, it's sort of two different types of investors typically.
What do you think went wrong, besides obviously interest rates going and jumping up as much as they have over the last like 3-4 years? Why do you think there's so much quote unquote distress or lack thereof in terms of this isn't '08, right? It's not, it doesn't feel like that, but interest rates yet it feels like it's a crazier change than it was previously. Like, what do you think's happening there?
Well, the interest rates have gone up substantially and they're not going back down. And that's, I'm not the only person saying that. I like to follow Howard Marks from Oaktree, and he's been saying that for a while as well. The era of zero interest rates, or effectively zero, is gone. And so the adjustment from that assumption that interest rates were super low and going to stay there to, oh geez, they're not going to be that low, they're going to be more normal, historically normal interest rates, call it 4% versus zero. That is an enormously painful adjustment. If you own any kind of income property, the value of your property dropped substantially when the interest rates adjusted up, cost of financing adjusted up, and cap rates adjusted up, which means values adjusted down. So that's number one. If it's a development-oriented property, like a parcel, an infill land parcel that's designed for redevelopment or something like that, you also have the issue that construction costs went up. So not only did the value upon completion go down, but the cost to build it went up for all the reasons that you know, Taylor. So that's a squeeze, and that's why if there are loans that aren't performing, it might be for either of those reasons or a combination of those types of things.
Are we headed for more pain, or do you think things are going to get easier with the macroeconomics? The Fed, they said they're going to reduce the rates, but there's still a lot of distress coming on. What does it actually mean? What do you think is going to happen if in the next 12 months? Do you think the Fed's going to reduce rates? And if they do, what do you think that's going to mean for the overall market?
Right. So I have what I call my circle of competence, and projecting what the Fed's going to do is outside of that. I don't like guessing. And so, but I do have a point of view as to, will there be more pain? I think that commercial real estate in California is in a painful spot in a lot of ways, because I think it's not just all the stuff that we've been talking about, but there is concern about policy, and will California voters and elected officials choose to pursue more policies that are anti-developer, anti-business, right? And that's a real threat. Like, will Los Angeles go the direction of San Francisco and try to be more practical, or will it go the direction that New York might be going, which is less practical? Let's go back to the policies that we tried in the 70s. Well, they didn't work very well in the 70s, right? So I do think that a lot of investors are saying California is a challenging place to invest. And I'm sure some of your other guests have talked about, 7 years ago, you say, we're in Los Angeles, we're doing real estate investment in Los Angeles, and the interest level is high. It's one of the top cities in the U.S. It's a place people wanted to be. Now it's kind of the opposite. I think when big investors, when you tell them Los Angeles, they're scared. And I think they should be. I think they should be a little scared until our elected officials turn it around and start being more practical and showing that we can solve problems, showing that we can do things as a city, and not just always pointing a finger at people that are doing well and saying they're the problem. They're not always the problem. They're creating jobs. They're being entrepreneurial. They're doing what entrepreneurs do. And if you continue to villainize those people and demonize them and say that because they're doing well, they're bad, and we should tax them more, and we should, make it painful for them, well, some of them are going to leave, like Elon Musk did.
Yeah.
And I think LA was lucky to have Elon Musk come down here from Silicon Valley when he did, and he created a lot of jobs, and he's created some really interesting companies, and now he's gone, and that's too bad. We want to attract people that are doing cool stuff. So I kind of went broad with your question for a broader answer, but I think that lending will continue to be very active. I think real estate investment will continue to be active because California is such a huge economy, and there's a lot of these properties that are just aging and need to be rethought. They need to be reimagined. There's SB9, which is, I think, very promising for small-scale development in residential neighborhoods, adding a few units in the backyard or a couple of units. I think I'm very bullish on that. But I do think that the era of, big projects in urban infill LA, I'm not expecting to see a lot of that in the years ahead.
Yeah.
I just don't know if you can do a big project. Why would you choose LA to invest large amounts of money what if LA passes some rent control thing or vacancy control, worse? That's a too much risk.
It is a big amount of risk. And I think that's sentiment is really what is keeping the prices low, in my opinion, because at a certain point, I'm selling deals that are positively leveraged day one, right? And I couldn't say that for Los Angeles my whole career. This wasn't around. And I think the reason of that is because of this uncertainty regarding it. No one can predict the risk of what's going to be happening. So are you telling me that if rates, hypothetically, right, now you're not predicting, but let's say rates do come down 75 basis points.
Which rates? 10-year treasuries or short-term rates?
Let's just say that the Fed drops their rates 75 bips.
Okay.
And obviously, most of commercial is pegged on the 10-year treasury note. So just because the Fed funds rate comes down doesn't mean that the 10-year treasury is going to come down?
Not at all. In fact, the 10-year treasury is kind of the benchmark that I think most affects income property values, right? Because it affects permanent financing, long-term financing rates. And the 10-year treasury is more linked to what is investors' confidence in treasuries, in sovereign debt. Do they believe we're going to solve our budget problems as a country or not? And so I don't think short-term rates and long-term rates are linked or correlated that much. And again, unfortunately, I think there's risk there too in terms of we haven't been able to solve our budget problem nationally.
Yeah.
Right? And when DOGE tried to cut costs, DOGE was ridiculed and the people involved in it. I just think, again, there's a lot of times where as a society, we kind of demonize anybody who's trying to cut costs.
Mm-hmm.
And the reality is we have to cut costs.
Yeah.
We have to find a way to bring the budget more into balance. We can't just keep piling on national debt. And if we do, at some point, the investors are going to find something else to invest in that's safe, that they feel is safe as well. And then our long-term rates could be higher. And then that would affect, mortgage rates on perm financing for apartments as well.
So you're saying that you think our value is going to go up?
Well, yeah, I do think values can go up over time for a lot of reasons, because this is complicated. But I'm happy to go there because I'm very interested in this stuff.
Yeah.
But it's very likely that there will be inflation pressure again, and we had a little reprieve from it. It popped up, and then we had a reprieve. But long term, there's a lot of reasons to think inflation will come back, and that will lead to higher rents unless there's rent control, right?
Mm-hmm.
And that will lead to higher values because ultimately the rent and the income are the driver of the value and the cap rate as well.
Sure.
And I don't think cap rates are going to go way up from where they are. I don't know if it's a 6 today. I don't think it's going to be a 7 or an 8 in the future.
Yeah.
It could go down to 5, right? But the bigger driver is what's the income going to be? And I think the income will be higher because I think that inflation will come back and everything's going to be higher.
Mm-hmm. So you think next year, because I'm having this conversation because LA has been locked up for since 2023, the beginning of 2023, when rates started jumping up, my business velocity just was right? In LA, everything was down 50, 60% year over year in terms of the number of transactions because buyers could not get their hands on the values and prices that sellers wanted from, the previous decade and era. So what I'm hoping is that we get to a place where I can sell deals in the 5 cap range because I think there'll be sellers there, right? And if the numbers make sense, buyers are willing to buy there. Do you think that happens in terms of the economics? Do you think the numbers are going to make sense if something happens with the rates? Or are you saying that you think the current debt rates that are happening, right? The 5.5 to 6.5 from more perm debt is going to be there even if the federal funds rate comes down?
Again, I feel like I'm outside of where I'm comfortable having a strong opinion on that.
Okay.
But the core question you're asking was whether will transaction volume return
Yeah.
because there's a bid-ask spread that's too big right now.
Correct.
It has been too big. And I don't have the answer to that. I mean, I think just using my observations of being in this industry since I worked for Sam in the early 2000s, very early 2000s, one of the things that drives apartment values is people have seen it as a good thing to invest in for retirement, right? Affluent people either own a building or participate in a syndication on a building. It's been a very popular thing to own. I do think that our policy, in a lot of ways in LA and also beyond LA in Southern California, the policy makers and voters have been signaling that they don't care too much about investors. I mean, ULA is an example.
Yeah.
That was awful. I mean, for investors, that was just a way of, it's put a huge damper on transactions and on development.
Yeah.
Because 5% of your sales price is probably about 50% of your profit.
Yeah.
And it's probably about 20% of your equity gone to a new tax.
Yeah.
So that was one signal. And then I think this whole rent control thing, I don't know what's happening with that. You would know a lot more than I do. But there's a general feeling of us versus them that I'm feeling out there. And it feels like a lot of voters would vote yes, even if the consequences are terrible for real estate investment. I think there's a lot of people that would vote in favor of some sort of rent control or even vacancy control. And there's not, unfortunately, I don't think we believe in the free market as much as we used to. I mean, we used to say, let's let the market take care of this. It'll produce what we need. I'll say on the positive front, sorry to blab so long, but on the positive front, I do think that SB 9 is a very positive policy change that will encourage production of housing.
Can you explain SB 9 to people who don't know?
Yeah, I mean, in short, this was passed back in late 2021, and it lets you build a couple of ADUs in the backyard if you, assuming you have room for it. And a lot of houses do have room for it. And it was a way of getting more residential units into the urban infill residential neighborhoods. It didn't really get implemented very much because the cities were still figuring out what it meant, and I think developers hadn't figured it out yet. But I'm starting to see now there is a growing number of developers who are coming to the cities, in different cities, and saying, under this state law, we can do X, and this is our plan to do it. And the cities are starting to approve that. And in some cases, they may have no choice but to approve it because it's state law, which trumps local law for the most part. Right?
Got it.
So I think it's encouraging for production of housing, which will help on the margin. I think it'll help with the affordability of housing. And it's dropping housing in the right places. It's also a competition for apartments, which is interesting, which I think it's a superior investment opportunity to multifamily.
Why do you say that?
Well, if you buy land to build a 10-unit multifamily property in LA, you're going to be paying how much for that land per unit?
Yeah,
Ballpark.
I mean,
Just
between 40, 50?
40 to 50 per door?
Yeah, for land,
So maybe to build 10 units,
Well, it depends. I guess
I
depends
think
on
it's
the.
more.
It depends on the most people are not going to build 10 units on lots in LA because most lots are like 50 by 150, right? So it's 7,500 square feet. So you're going to try to build more density.
Well, I guess what I'm saying is apartment land trades at a certain price, which has
Yes.
been pretty high.
Yes.
Per unit, you pay for the land per unit a pretty high price. And what SB9 is doing is it's making it so that you can build units on the backyard of almost any residential parcel, especially if it's a larger parcel.
Mm-hmm.
And generally buyers are not having to pay such a premium for that. That backyard land is getting thrown in for a relatively reasonable extra cost, not that much increment. And so they're getting land at below market value. And that's why it works, because it's allowing them to build a new unit and rent it out. And instead of having to rent it out for X, they can rent it out for 20% less than X and still make money because they bought the land well.
So you think people are going to buy homes or duplexes or triplexes as investments, right? And then build those and kind of make it like a quasi apartment complex.
It's happening. I mean, we're lending to people that are doing this right now. They're building, they're building fourplexes, but they're building them in residential neighborhoods, not in multifamily neighborhoods.
Interesting. Do you have to lot split, or is there any?
Well, you can. There's other laws that are allowing for, you do not have to lot split, but the ability to sell those new units as condos.
Yeah. Wouldn't something pass? And I don't think, doesn't the city of LA have to adapt that to then be able to, because that was when it first came out, people were saying you could sell ADUs.
And in San Jose, there are ADUs for sale right now. The first city to allow that is San Jose.
Wow.
And I'm watching that carefully, but I think this could be terrific for California because, again, it could be a way for people to own their own home. Their yard won't be as big as their neighbor's yard, but who cares? I mean, if you want to live in California and raise a family, you have some outdoor space for your kids.
Sure.
You don't have to have a huge yard.
Yeah.
New York City and Manhattan, people aren't expecting to have a huge yard.
Yeah, it's true.
And a lot of people want to live there. So why do we have to have all this wasted backyard space that is grass when it could be housing for families that have, that have jobs here?
Yeah. Yeah. It's interesting. I think, again, LA's and California is a pretty NIMBY state, I would say, right? There's a lot of laws that are Newsom and the state is trying to do a lot to make that not the case. But people, I mean, no one wants a 6-story apartment building next to your single family home.
Yeah.
Right?
I mean, it's fascinating to see how the state laws, which are YIMBY, yes, in my backyard, yes, pro housing development, pro affordability through extra housing, how will that interact with the local NIMBY culture, which has been so dominant for so long? But I wanted to mention that because I said some stuff earlier in the interview that was concerning about policy, right? This is a policy initiative that I think is potentially very beneficial, and it's very innovative thinking. It's a land use change that could allow us to have more housing, which could, on the margin, bring down the cost of housing.
Are there any policies you're tracking or that you think potentially could happen that would even improve that further?
Well, I mean, there's a whole bunch of laws that have been passed beyond SB9, some of which allows for, we were talking about, sale of condo ADUs. Some of it may allow for lot splits into smaller lot sizes. In some cases, it might be possible to build more than 4 units on a lot. And so I'm trying to understand all of those things and watch them and see how they play out. And we're actually doing a virtual panel discussion with some developers from different parts of the state that are doing this.
Okay.
To talk about what's their experience, how's it going, what are the obstacles they're facing, what's working. And so if anybody's interested in that, then message me and I get you the info about that conference.
Yeah, that's super interesting. I'm because developers are the ones who feel it, right? They're the ones risking capital, so they have to figure out what makes the most sense. Where's the alpha in those opportunities?
Developers are putting capital at risk. They're putting enormous effort into these projects, and we want them to succeed. I mean, for them to, if they succeed, that's good.
Yeah. Yeah, I agree with you. I think it's funny how many times I have to repeat myself, but supply and demand still exists. And so if you want rents to come down, then just make more supply. It works everywhere. I've ever seen it be done. So if we can make it easier to have more supply, then all of these rent problems, rent going up, yada, yada, yada. Maybe it's not great for the investors, but most of the people who are voting don't care about the investors, as they've clearly said. Make it easier to build. Like, that is the solution to all of your problems, or to most of the problems when it comes to the rent, at least. Can you tell me about the Palisades and the fires? I was surprised to hear that you're doing like your own podcast series, but what's the fascination with that, or what's the story there?
So I moved back to California about 6 months ago, right after the fires had happened. And so it was top of mind. And in my prior business at Arixa, we had made a lot of loans, especially in the Palisades, to builders that were building homes there. And so it immediately occurred to me that some percentage of these homes are going to be rebuilt, are going to be built by developers, not necessarily by owner occupants. Not everybody who lost their home is going to be able or want to rebuild their own home and move back in. In fact, I think the majority of homes will end up being sold to developers, and those developers will be the driver
Like
of
spec homes.
I think that's going to be the driver of the rebuilding.
Okay.
A little over a majority,
Sure.
or in some case, maybe in Altadena, quite a bit more than half.
Yeah.
I'm not sure yet, but it was very simple. As first of all, this is the city that I raised my kids in, the city where I made my career in real estate happen, and what can I do to be helpful in this moment of incredible challenge to our city? And I realized, if I could be a lender to some developers in the fire zone, on the margin, that's going to help a little bit. So let me figure out how to do that. And in order to do that, I needed to get informed about what's happening with the rebuild and what are the big obstacles, and how's it actually rolling out.
Mm-hmm.
And so I realized I needed to start talking to people, and I decided that if I have these questions, there are probably other people who have similar questions. I thought of doing some live events about it, but then I realized doing it in an interview series was a good first step.
So then what is your findings? What have you discovered?
It's still really early days. I've only interviewed four folks so far, and I've got, maybe another 10 coming up between now and year end.
Yeah.
But unfortunately, I have become a little discouraged about the timeline for rebuilding through my initial research on this. Initially, I was thinking, give it 10 years and these communities are going to be thriving. They're going to feel like, fully functioning neighborhoods again.
Yeah.
I'm starting to feel like it could be longer than that. And that's unfortunate, but I think that there's a great silence coming from our leaders and policymakers about the fires right now. There shouldn't be. And again, I don't know how else to say it. There needs to be some leadership. There is a structural problem in the city of LA and LA County that there's not a strong executive function. It's very distributed power among city council members or county supervisors, but that is turning out to be not a good thing for rebuilding. What I think we need is somebody to get out there and say, we're going to make sure this rebuilding happens, and we're going to, whatever the obstacles are, we're going to find a way to blast our way through them. Bring me the next obstacle. What's the obstacle today? Decision made, on to the next. What's the next
Action.
obstacle? Decision made, on to the next. That is the opposite of what's happening.
Yeah. Do you think Caruso is that person?
Well, I do think he runs his shopping centers well, and so he probably would, in a certain way, be a good manager, executive for the city. And I don't want to get into politics, and I don't want to speak in favor or against any particular person. I'm just saying, to get a rebuild done, you need an executive function, and you need a visible leader in front of that. And that is very much absent right now. It's dispersed effort, and there's not clarity on many of the big questions are unanswered.
Mm-hmm.
And so I've become a little concerned that it's going slowly.
Does any of this AI tech, when it comes to like streamlining the rebuild effort, is it fugazi? Is it legit? Is it,
Well, the latest person I interviewed was Kennedy Zach from the Los Angeles Business Journal, who's written a series of stories about the rebuild, and she's been following some technology innovations that might be helpful on the margin. I have not seen anything where I've said, wow, that could make a huge difference here. I feel like our industry of development is still doing things largely the way it did 50 or 75 years ago, stick built. Like building a house is pretty much the same process now as it was 75 years ago, which is incredible if you think about it, because think how much the world has changed in that time. I'm eager to see breakthroughs that change that, but I haven't seen anything yet where I would say that's a breakthrough. And factory built, how we're building components and doing as much of it you can in the factory has been the big hope for a long time, that it would take cost out of the equation, take time out of the equation. But again, I haven't seen it in practice yet where it's making a breakthrough.
It's maybe a little bit, from what someone was telling me, a developer, they're like, it maybe saves you a couple months on something, but the costs are about the same. It's not anywhere cheaper than, if maybe a little bit more expensive, I guess, in terms of actually getting it done. Is that what you're seeing too?
Well, I think the costs are probably similar, and it could save you some time, but we wanted to encourage innovation at when I was at Arixa, when I was running Arixa. I liked the fact that as a lender, I could be a little bit innovative and back people that were doing innovative stuff that helped address our problems with housing, right? Affordability, all the issues that you know about. So one of the things that we did is we lent money to some people that were doing factory built townhomes. And in one case, what happened was the factory completed the townhomes, but the foundations weren't ready yet. So the developer was not ready to take delivery of all of the houses that had been built in the factory, right? So there was a big dispute that happened. Then the factory, and we shouldn't be getting involved in this at all, but the factory was saying, like, we're not holding on to these. We don't have space for this stuff. We are not going to hold it. And the developer was saying, it's not my fault that this foundation is running behind and I'm not ready to. So factory built has those kinds of challenges.
Interesting.
That are not there with stick built.
Logistical.
Yeah, logistical. And overall, I would love to see innovation come into our industry more, but I am not seeing anything that I would say what a breakthrough that is. It's not like ChatGPT, you use that, or the internet when it came around, which is, you wouldn't remember. It probably came around while you were a little kid.
Yeah.
But when we saw those things, like, we knew this is changing the game big time. This is completely revolutionizing things.
Yeah.
You can feel it. I don't see that in housing. I don't see that in construction and development. I don't see anything like that yet. I hope I'm wrong, though. So tell me if I'm missing something. Message me and tell me about it.
Yeah, I'd love to know too. I think it's about time. Real estate is an old industry. We know that, right? We're behind 20 years for most other technologies. So there's a reason it's hard, and clearly there's a reason people want to put money into it, because it feels like it's like about time to do that. But clearly there's other factors that make it just really hard to bring up to the times. Are you using any technology, AI, anything in your actual lending business? Like, are you trying to figure out how to streamline underwriting or valuing borrowers? Or are you doing anything from your actual lending business?
Well, I want to be a fast follower in adopting technology. I don't want to be the pioneer figuring out if it works, but anything that works, I want us to incorporate it into our business quickly. I have a son that works in the AI industry in San Francisco, and so he and I have had a couple of conversations about how might that apply into the lending business. But I see our business as very much service oriented, and so the analogy I use the most is in and out, right? Why do we both love going to In and Out?
Yeah.
It's not because they have some special technology. It's because, it's clean, and the person that takes your order smiles at you almost every time, and the food is consistently really good, and the presentation of food is amazing, right? It always looks perfect.
Yeah.
And those are the things they get right. And that's why they win.
Mm-hmm.
And, they're not the only ones that win, but they win big.
Yeah.
In my view. In
For
fast
sure.
food, they and Chick-fil-A
Yeah.
are on a different level than everybody else. And that's how I see lending as well, is we're service driven. We have to deliver those things that the borrower or the investor care about, and using technology may or may not help, but it's not what your customer ultimately cares most about.
What is it? What makes a good servicer of, you mentioned for your borrower, right? What makes a good lender? Like, what are those things that they actually do?
Well, I mean, first of all, here's my business card with my cell phone on it. Call me anytime if you have any concerns.
Okay.
That's number
direct
one.
access. Yeah.
Like having a direct access to a decision maker who can say, you got an issue that's out of your control, you need some extra time on that, or you want us to, this would be a default technically, but we're not going to make it into a default. That's what matters to borrowers, right? I think that be certainty of execution, getting decisions made quickly,
Mm-hmm.
being able to meet your lender at the property and have them show up on fairly short notice and make a decision, and tell you whether they can make the loan or not. Obviously, rate matters, but it's not the number one thing, because we're all pretty similar. We're all within a little range of each other.
Yeah.
So I don't think rate is the biggest driver for our borrowers either. What else makes a good lender? I mean, being able to perform. And as a construction lender, that is easier said than done as well, because when we make construction loans, we're committing to have liquidity when the borrower is drawing down their construction loan.
Yeah.
And some construction lenders have gotten too excited about making loans and not worried enough about their future liquidity, and not planned enough contingencies for making sure they can fund all their construction draws. So that is hugely important to our borrowers, is, can I trust Jan and his team that they sweated the details? So 9 months from now, when I say, I just did this phase, I need a $200,000 construction draw, what you don't want your lender to say is, great, give me a week or two, and then we'll be ready to fund that. That is not the answer you want.
Yeah.
So just being, prudent and thoughtful about how to run the entire business is what matters.
What's your plan to become massive again? Because I know it sounds like to me that you're pretty much, you want to build something great again. You want to build the next big thing. Like, how are you going to do it?
Well, being massive is not anything like the goal. I mean, I don't think we need to be a big company.
Okay.
I like growth because it's fun to have growth, and
Yeah.
it creates career opportunities for your team. And it happens naturally. When you're doing everything else right, it happens naturally. Just like In-N-Out, right? They're growing.
Yeah.
Because why? Because you go in there and they keep delivering the goods every time. If they screwed that up, they would not be growing anymore. But they haven't screwed it up.
Yeah.
So they took a long time to get big, right? They were small, regional for a long time. And that would be just fine with me too, is we're regional in North Carolina, Central North Carolina, and Southern California. That's where we are. That's where we have boots on the ground. And I want to be known as a great lender to work with in those areas, first and foremost.
Okay.
And if it grows and gets bigger over time, great, but that's not the goal.
So then, but let's say you do want to grow, right? Which a little bit, but you don't need to be massive. Are you spending time going on investor meetings? Are you reaching out to brokers? Like, who's bringing you business to grow the business?
Yeah, well, in order to grow, we need 3 things, right? And I spend time on all those things. One of them is we need borrowers contacting us. And I like doing events on topics that I think are interesting, because it attracts the kinds of people that are potential borrowers.
Yeah.
I also think it's incredibly important to get referrals from your existing borrowers, because that's a sign that you're doing your job right. Right? So you need that. You need capital. And yes, we are spending time talking to capital providers of various kinds, and that's a slow process, but a certain percentage of time goes to that. Again, I like doing a lot of writing, so I find that that's another way to raise capital, is to be considered an expert, and sort of like let people know indirectly that I have a good track record as a portfolio manager.
Sure.
By writing about how does this industry work. So raising capital is the second part. The third part for growth is operations, right? And let's go back to In-N-Out. It doesn't matter. Nothing else matters if you get your burger and it looks terrible.
Yeah.
It's like game over.
Yeah.
They lost it.
Uh-huh.
And so you have to get the operations precisely right. And you have to get it right like 99% of the time.
What does that look like? What is a perfectly assembly lined operations from borrower contacts you to actually funding the loan? And then,
Well, it's pretty easy in our case to figure out if we did it or not. Because if you ask the borrower, did we do a good job for you or not? And they say, you did a great job for me, then we did it.
Got it.
And if they say anything other than that, then we didn't do it.
Uh-huh.
And I'm very fortunate because with Greg, who runs Arixa now, we kind of created our own formula of how we thought the borrowers should be treated. And it turned out to be a really good formula. And, I feel like I have a vision in my head of how to service borrowers and how to do this whole business, which we kind of developed together. And, I started it a few years before I met him, and I gave him great service on the first loan I made to him. That was like that was the template, was driving down to Orange County on a Sunday morning after meeting him on a, Saturday, and calling him on the way back saying, yep, we can do this loan. And he remembered that.
Yeah.
It impressed him. And that's kind of our brand statement. And I think that we're going to stick with that. We want to impress our borrowers. We want to go the extra mile. We want to take care of them. We want them to succeed. And they need us to be really good at this for them to not have to worry about the loan part of this. Because there's enough other things they have to worry about, like construction costs, getting approvals for everything, buying property at the right price, and all those things. It's really hard to do what they do.
Mm-hmm. What does your back end look like when someone calls you and says, hey, I need a loan for this? Like what parts move
Yep.
when you get that initial inquiry?
Yep. So if I have somebody contacts me about a possible loan, I will qualify it myself based on, does it fit our model or not?
Okay.
If it's residential, kind of under $3 to $4 million, non-owner occupied, business purpose loan, we're probably pretty open to it. Now, the location should be somewhere that we can get to easily. And if it's not, we may not be the best lender for that. And I like to refer to other good lenders if I can't do the loan. I find that that's a way of getting referrals back as well, right? We like referring to each other. But if it's in our region, in our strike zone, I'll bring in our head of operations, lending operations, and also we have a local originator in LA. So both of them, I will introduce the borrower to both of them and say, we want to check this out. We want to let you know what we can do. Let's set up a time to meet you at the property. And then I'll show up for that meeting. I like to see the property myself and meet the borrower.
Mm-hmm.
But in addition to me, our local originator will do that. And then our head of lending operations he knows to make sure that things need to keep moving. Communication needs to keep moving with that borrower or broker, if it's a broker, right? And we just need to consistently let them know, where are we? When are we going to be able to get you a letter of intent? Are we on board with your closing deadline? If we're not, if we don't think we can do it by the closing deadline, then we have to say no right away. We have to let them know right away. Hey, this closing in 2 days, we can't do that. This closing in 7 days, we could probably do that.
So you can do loans in 7 days because
we probably could, but typically 2 weeks is a nice lead time.
What happens? This is always where inefficiencies for me. I'm like, why the fuck does it take this long to understand if you can lend on a property? Because I can value a property in about 30 minutes.
Yeah.
If less. Like, I can almost look at something and be like, okay, this is going to make sense.
That's half the battle. Valuing the property is half the battle.
Is that what takes the most time for lenders?
Well, it shouldn't take that long to value the property. But the other thing that matters is deciding, is this a borrower we want to work with? Right? And
like background checks.
Well, we do a background check the first time we lend to somebody. But just, is this borrower going to appreciate what we have to offer? Are they going to treat our team, well?
Yeah.
Because life's too short to work with borrowers that don't treat your team,
sure,
with any respect. So, Then there's also the execution part, right? Because most of our borrowers are doing projects where there's construction involved. They're adding units, they're adding
Got it.
square footage, they're building something, or renovating, or
Yeah.
both. So then you have to get into, is the execution, is this borrower qualified to execute on the project the way they're saying they're going to?
Got it.
And if they can't do it themselves, have they built the right team around them? Like, do they have a strong GC? And maybe we need to look at that GC's experience, and maybe that compensates if the borrower hasn't done a project quite like that. Sometimes people want to do projects that are outside of their own circle of competence. That's always a big red flag, is the person that's been doing $1 million projects that suddenly comes to you with a $15 million project. They're probably going to get in trouble with that.
Yeah.
I've experienced that personally, actually, on multifamily, where someone had done a lot of smaller projects, and then they got into a bigger project, and they just didn't have the stuff they had worked out that worked for them before. It just didn't work on the bigger project.
Yeah.
And,
it is what it is.
Yeah. And so we're going along with the borrower. Choosing the right borrower is actually the majority of the challenge for us.
Got it.
Because if we choose good borrowers who make money consistently, who know their lane and stay in their own lane, they're going to make money most of the time, and they're going to pay back their lender almost all the time.
Yeah.
And we're not lending 100% of cost. We're lending 75, let's say. So we have a margin of safety there, where even if a project goes unexpectedly a different direction, or the market changes a lot, we should not lose money, other than in the rarest of examples.
So if I wanted to get money from you in 7 days, what would be the best case for me to bring to you to be like, okay, I can make this happen in 7 days? Like, what, as someone who, a borrower, like, what can I give you to make your life easier?
Well, if you have a project and it's closing in 7 days, that probably means you have another lender that didn't perform, and you're making a purchase which is very advantageous. Something like that, right? So the way I would answer that is, let's meet at the property. Give me the address. How soon can you meet me there?
Okay.
We'll go down there, we'll check it out, we'll see what's going on. And you're probably gonna be saying, this is an extremely advantageous purchase. That's why I don't want to mess with escrow. I don't want to ask for more time. I don't want to go back to my seller, right? So I want to validate. You're saying you're buying it at a great price. Help me understand that. Help me see that you actually are buying it at a great price.
Okay.
If you're buying it at a great price relative to market, that's good for me as a lender, because it's more margin of safety.
Yeah.
Right?
Yeah, for sure.
And if you have a plan to do something with it that's incredible value add, that's good for me too. But you need to be qualified to execute on that plan, right?
Do the borrowers show you our broker comps? Like, do they come with you with comps about, hey, here's...
we love having comps, but we also want to get our own independent point of view, one way or another. So, I might be calling you to get your opinion about a loan that somebody else brings me in the future, because, I know that multifamily in LA.
Yeah.
So I think a lot of it boils down to having brokers that you really trust. And I always like to tell them, brokers or realtors in the single family area, I always like to tell them, like, if I make this loan and it doesn't work, something happens to the borrower and I have to get it sold, I need to know, what will it actually sell for?
Yeah.
Not what's a reach value, or I hope it could sell for this, or if we find that one buyer, it could sell for this, but more like, liquidate this for me in 60 to 90 days.
Yeah.
What's that dollar number?
Got it.
Don't exaggerate. Don't tell me what you think I want to hear. I just want to know the real kind of market clearing price, not a distress sale price, but definitely not a reach price.
Got it.
So I don't know how we got into that.
No. I because I like to understand how the cookie's made, how the dish is made, because sometimes I don't get a look into why things take as long as they do, or why someone says they need an extension. Like, I'm not dealing with the actual borrowing of the assets, or connecting with their GC, or all that kind of stuff that goes, because I'm a broker. I do the sales stuff. So for me to understand what actually is happening behind the scenes, I think it helps me to then relay that information to the seller or to the buyer or whatever it is, because certain things to me feel like they take longer than it should be.
Yep.
But again, I'm not in there doing it.
Well, I mean, a big reason that lenders take a long time is when there's multiple layers of decision makers and committees,
Oh,
and then just organizing schedules and getting people to see it and write-ups. That's why I'm convinced that we can compete, even though we're new on this scene,
Yeah.
this new company. Because I can personally show up and see the property, and I am the investment committee
Got it.
for my company, and I'm also the biggest investor in our fund, and so, you know, that's competitive.
Yeah.
That's valuable.
Speed.
And in terms of your questions, speed and certainty of execution,
Yeah.
right? The other thing you asked was, what else has to happen if someone needs to close in a week or two? After we meet at the property together, and I get a sense that this really is a good buy, you really are a borrower that I want to work with, there's a lot of stuff that has to happen behind the scenes, but it's our job to let you know, this is what we're going to need. Get it to us quickly. We will turn it around, and we'll make sure that we hit your deadline. And that's a big part of what, again, is part of the formula that I worked out with Greg was, let's make it as easy as we can on that borrower. But the borrower still needs to give us the stuff that we need, like your track record. We want to know, if you're a first-time borrower from us, what projects have you done? What have you owned? How did those projects work out? Like, share that with us, and hopefully you've got it organized in some way, and we can see that you're capable and experienced. Not every borrower is super experienced, but it's our job to say, once we've met you and said, we like this loan, get you an LOI, we have a signed LOI, it's our job to say, these are the things we need. There's no box checking here. It's just, what do we really need to know that this is a safe loan for us? So we keep it to a minimum, and then get us that quickly, and we can process it and turn it around. And, if there's anything in the background check that's going to pop out, tell me about it up front.
Yeah.
Like, I want to know now so I can make a decision about it.
The last thing I want to talk about is the actual money, because we talked about this on our prep call, and it was just, I like, again, how the cake is made. Let's see, $1 billion debt fund, right? $1 billion assets under management. What is the money being made? How does that tip? And again, round numbers, right? But like, how much money is a debt fund that's worth has $1 billion under management? How much are they making?
How does the revenue work?
Yes.
Yeah. So I think in private credit, and this applies to real estate private credit and other forms of private credit, you can estimate the revenue of the company that runs the fund and that originates the loans by taking a percent, like maybe a 1 to 2 or 2.5%, depending on the details, and multiply that by the size of the loan portfolio. So $1 billion fund, if their model is that they have a 2% revenue on that, maybe they get a point from the borrower and they get 100 basis points a year from the investors on average, that'd be a $20 million revenue for $1 billion fund. And, and there's big companies in private credit, like Ares, one of the biggest, and they're here in LA, started here. And that's a company that has a lot of revenue. They have more than 100 billion, well more than 100 billion in private credit. And so that means they're probably looking at, $1.5 billion a year of revenue minimum.
Wow.
On that 100 billion of private credit.
And the profit margins are like 30-ish% typically?
I think it varies. I mean, in the investment management field, though, 30% is probably about where you want to be.
Yeah.
I think 25 to 35 or even 40 is the range. But whether you look at the big guys like Blackstone, which is public, of course, or small companies, it's not, you don't want to be running this type of business on a small margin. And, because the key people that do these businesses are taking risk in different ways. And so just like if you were doing a real estate project, you wouldn't want to do it based on, I think I can make 7% of my money there.
Yeah.
That's not good. You want to go in knowing, I think I can make a good margin on that, because it doesn't always work out, right?
Totally.
You're going to have expenses that come up unexpectedly. You're going to have setbacks as a company. So you need to aim for a healthy margin.
So fascinating. I love this business. Jan, thank you very much for being here. This was awesome. I learned so much about private credit. I'm excited to go back home and dig even further into it because it's just fascinating to me. So I appreciate your being on. Thank you for doing this. Thank you for sharing. And I'm excited to see the new company grow, and maybe we'll be doing some loans soon with my borrowers, and who knows.
It's my pleasure, Taylor. Thanks for having me.
Thank you.